the half-year results, really there was a bit of a misunderstanding in some parts of the market, and that really relates to the performance fees in the business. The funds under management over the 6-month period measured to the previous 6 months were actually up 10%, and the underlying profit was actually up 9%, but the headline profit fell around 20% year on year, and that was solely due to the fact that last year we had $44 million of performance fees, and this year we had slightly under $4 million of performance fees. Performance fees are measured each 6 months. Some 6 months we will get zero performance fees because we may not outperform the relative benchmarks that we have for performance fees. And in some periods we could get $100 million of performance fees. Of course, our profits would be smoother if we didn't have performance fees, but the business is substantially more valuable in the long run with the fee structures that we have, which we actually think are very fair for the clients as well. I'm not going to spend that much more time on the results. I think they've been written up by Morgans and been well covered. I've said this many times. I think we have a very well-balanced business, sometimes not understood. People said we've only got 30% of our business in retail and 70% in the institutional business. Both businesses are incredibly valuable to us. The institutional business is diversified by clients. There's over 110 clients around the world, and it's split into 4 jurisdictions that I'll take you through. But the retail business, even though it's 30% of our funds under management, it's nearly 60% of our base management fees. So well over half of our business is actually the retail business we have today. And I think both parts of the businesses react in different ways at different times of the cycle, and provides a very steady and diversified business base. What's important for people to understand is our retail business and the strategy we've had in our retail business. It all started with independent financial advisory firms, and then ultimately with stockbroking firms. I describe this as sort of top of pyramid strategy, where we come and form a relationship with a group like Morgans. We talk to your research size, it gets approved, and then from that base, the group and the advisors effectively have all the client relationships. We don't have any direct relationships with your clients. It's all intermediated. And we now have over 500 independent financial planning firms and over 40 broking firms in the country. Believe it or not, there are 40 broking firms in this country still, using our unlisted funds and our active ETFs. The second part of the strategy, which was obviously harder to do business on terms that were acceptable to Magellan, was actually getting the large banks and AMP on side. 4 of the 6 large institutions we've got holistic relationships with, where they have effectively a bespoke version, their own version of our global equity fund or our infrastructure fund available on their platforms, and then they're effectively put in all the model portfolios or many model portfolios across the groups. There are 2 groups we are not in holistic relationships. One is NAB and one is ANZ. We are making a lot of progress. Obviously, ANZ Wealth Management's being sold at the moment, or the asset management part of that business. And frankly, we haven't been able to do with NAB because they haven't actually had a business model where we could have that type of bespoke relationship. But we've been working on it for a decade. Eventually, we will get there, or they will get there. And the third part of the retail strategy that's important to people understand is that it's an incredibly large, truly self-directed investment market. It could be self-directed, self-managed superannuation, or it could be just pure investments. This part of the market is almost completely uninvested in international equities. It's largely term deposits, property, and some Australian equities. The broking firms tend to get some of the business when they transact equities, but these people kind of think they want to do it themselves. This is a very difficult part to get right because it's not top of pyramid. There's like 1 million of these people or more, and it's like herding cats. So how do you herd 1 million cats in an efficient way? No one's been able to do it to date. Obviously, we've now got an active ETF to go after that. I think you'll hear more about us in the future as we start to do things to see if we can scale into that part of the market. We fundamentally don't think it is right for these people that they have no investments in international equities, given what we think is happening in the future. But we have to help educate this part of the market. Ultimately, when they get more educated, they may want to go and get some advice to work out that some of this is complex, and even if we educate them on the story, is it right to choose Magellan? How are they going to answer that question? We, of course, think it's right. On the institutional side of the business, it's pretty well diversified. North America has 10 billion of funds under management. The UK, we have one person servicing the UK, and we have a $15 billion business in the UK. Rest of the world is predominantly Singapore and Taiwan, and then Australian institutional is 4.6 billion, and we're very diversified by client type in the institutional business, so nearly 33 billion in funds under management institutionally. We mentioned at the interim results the launch of some new strategies called our low carbon strategies. They're effectively brother and sister strategies of our core global equity strategy, but they are focused on a low carbon part of the universe. We believe this is a very large unmet institutional client need as more of the regulators around the world start talking about carbon as a factor risk and start talking to large pension funds around the world about how much carbon exposure do you have holistically in your portfolios, and you need to manage that amount of risk. People will start to look at how do they put their investment portfolios together that they may manage that risk. At the moment, all the solutions are either what we call deep ESG solutions or they're passive solutions. There are really no concentrated active equity strategies out there around the world. So we're coming out, and there's well over $1 trillion that are following low carbon at the moment. So we're not talking about a small market here. With all these strategies, we have 3 of them. We have a new global equity low carbon strategy. We have a US equity low carbon strategy, and we have an international equity, a non-US equity strategy. Obviously, the last 2 are really only applicable for the North American market. Both US equity and non-US equity is how they predominantly invest, and the global equity strategy will be available everywhere in the institutional world. We've launched the global strategy with a fund out of Ireland, and we'll have a fund up and running soon in the United States. Then will come the US low carbon, and then we'll be followed by the international low carbon. I'll talk about the capacity of these strategies, but they're relatively large and scalable. I should be a caution, this is an institutional product. You need a minimum of a 3-year track record for institutional consultants to get on board. Often you need 5 years. So we're really thinking long-term around the opportunity. We may get some breaks from people who know us very well, and given that leverages off our whole intellectual capital of people who know us well. But I just want to say to people, we're really not focusing on any material traction. Over time, we'll be building out our North American distribution team. We'll be maintaining our relationship with Frontier Partners, but we'll be building our own team. I think we have, Frank, now 4 people in that team, and we have the infrastructure in place, and as we're building the track records, we'll build out that team in North America. What's the theoretical capacity of Magellan at the moment? Well, we have $46.5 billion of funds under management at the moment, about $34 billion US. The total capacity of the 3 strategies we now have, global equity, listed infrastructure, and now low carbon, is $85 billion US, or over 110 billion Australian dollars. So even though we're relatively large, we would argue that there's still plenty of opportunity for what we're doing at Magellan, and that doesn't even take markets growing over time. It's completely conceivable that we could be running, if we're successful, a few $100 billion in the future. And what's very nice is they're entirely scalable. We other than a few more people in North America, we literally don't need any more people to do what we're doing. Not saying we won't hire people, because we've got other things we're thinking of as well in the future.